Hi, everybody. I'm Bob Marone for Westchester Talk Radio. And once again, we are with our friends from Hightower Westchester. Today's topic, it affects all of us in this day and age, the pros and cons of high interest rates. And we're here with Roman Ciosek. He's the managing director and partner at Hightower Westchester. Roman, this is a timely topic, and you can even use me as a guinea pig today because I am soon to be in the market to buy a new home in this interest rate environment. I think it's important to understand how and why we got to this increased interest rate environment. Could you please provide a little context? And thank you.
Bob.
It's good to see you again.
Always a pleasure. Thank you for doing this and having us on. So certainly interesting times like always. And I think it's important to have a little bit of context around what's happened to understand as far as where we are and where we're going. Over the last 3 years, as many of us know, there's been a significant increase in monetary policy and fiscal policy. Clearly, we were in unprecedented times with COVID, which has led to this. In other words, the government had kept interest rates at almost zero for quite some time. And at the same time, they infused the economy with trillions of stimulus dollars to help the overall economy grow, or at least maintain growth. This ultimately has led to a 40-year high in inflation, and the Fed is aggressively increasing rates to help fight and bring inflation under control. And there are other variables as to what have led into the inflationary picture. However, just to keep it relatively high level and simplistic, this certainly has played a significant role into the environment that we're currently in.
It's an interesting summary, and as I'm sure it is more complicated, but clearly something the federal government needed to get under control. Now, knowing that backdrop, let's look at some of the negative impacts of higher interest rates and strategies that we should be thinking about.
Yeah, sure. So clearly the cost of capital has increased, or better yet, the borrowing from banks has increased significantly from where we were a couple of years ago to where we currently are. I mean, just as an example, as many of you do know, buying a home, right, for a 30-year mortgage is a little bit north of 7%. And when you look back 3 years ago, rates were about 2.5%, 3% for a 30-year mortgage. So you're looking at a 100% plus increase in the amount of rates that currently the banks are charging. So the double-edged sword here is that for the home buyers, or the people that are looking to refinance or buy a new home, better yet, like yourself, is that home prices have gone up, right, in many different markets, and at the same time, rates have gone up. So being an individual and trying to buy a home, it's that much more difficult because you have this double-edged sword of higher costs and higher interest rates as well. So it's becoming more of a challenging environment overall.
Wow. The folks, we video stream this. You may have seen me grimace at the interest rate. So this next question is also personal. What are you telling clients that are looking to buy a home now?
Yeah. I think, like, from our world, right, every situation is a bit different. As you know, we spend a lot of time around financial planning, and really it's about stress testing the various different scenarios to analyze the overall budget for an individual to make sure as to what is affordable to that particular family, if you will. Some solutions that we really look through are to consider maybe taking out an interest-only mortgage, or perhaps putting more capital down to reduce their overall payment. The goal is to ultimately refinance when or if and when rates do come back down, right? So that's kind of the goal, is to kind of do something now and then eventually refinance when rates come down. Renting is certainly an option. It's a short-term option, but it has some solutions. The rental market has increased as well, but it's something that we're recommending to clients. We do not recommend rushing into things. As we all know, buying a home or selling a home is an emotional part, and you should always base your decision on facts and being strategic and long-term.
Wow. And a follow-up question, if I may. Have there been situations where it might be better for someone to rent out their home rather than sell it if they have a low interest rate?
Yeah, no, that's a valid point. The answer is yes, and it depends, right? People have rented out their home, and because the one big thing right now is if you're looking to, let's just say in your particular case, if you're selling a home or two, and if you have a mortgage at, let's just say 3%, well, what's going to incentivize you to buy a home for comparable amount or more with a double rate interest rate on there? So people have decided to hold on, rent their home, but the risk that you're taking there is that if all of a sudden prices do come down, then you're selling that home at a lower value. And what people also have done is that they're going to hold on to their home and they're going to buy a new home. Now, if they have a portfolio of X amount, now you're increasing the amount of real estate that you're holding on to. And if the real estate market does come down, now you may have another mortgage, and yeah, you're getting some rental income, but eventually, if and when you have to sell, it becomes that much more challenging.
Yeah. This is apropos of the mantra that you and your colleagues talk about all the time, which is to look at all of things, everything within your portfolio, et cetera. What are the other areas that you're seeing with higher rates affecting your clients?
Yeah, the other part of it is I think, Bob, as you know, we do a lot of podcasts around business owners. As the cost of capital has increased for the business owner, for them to get new loans for capital expenditures, increase their business, or buying properties has increased significantly. So that has become more of a headwind to help them structure and to grow their business. So in certain instances, what we're seeing is that the business owner is although they're spending maybe a little bit less on capital expenditures, they're looking for alternatives, or they're even looking to buy some used equipment to decrease their expenses. So that's certainly an option.
Wow. Now, you mentioned these business owners. Are they being impacted by the rates increasing here?
Yes. So in general, depending on the industry, we are seeing a much tougher environment, and many are concerned about that big recession. And that's something that's become a viable question, and it's the buzzword of last year. We've yet to see it or any significant signs we are in or nearing one. And there are various different schools of thought around that, as we all know. Yes, the economy is slowing down. And, historically, it does take 12 to 18 months where the increase in interest rates by the Fed does have an effect on the overall economy. But with the unemployment rate at 3.5% and the increase in wages, it is tough to predict when we will be in a recession. But like all cycles, it is something that is inevitable. But trying to time it is really impossible.
Wow. Now, I'm sure that also translates to the stock market, volatility, uncertainty, and so forth. What can you say about that?
Yeah, it's a good point. I mean, it has been a challenging environment for the stock market. If you look back last year, markets down 20 plus or so percent in general, and this year markets are up double digits. But it's a tough environment because the various markets are outperforming, certain markets are underperforming. And when you look at the overall S&P or broader market, yeah, the market's up, but it's up based upon a handful, 8, 9 different stocks that are up. And unless you own those 8 or 9 stocks, you're really not participating with the same double-digit returns. So it's not a healthy environment until you see the overall broader market participating in this particular type of upside. But like all investments, we have a longer-term horizon. We're not looking at this day to day. Our long-term perspective is to kind of weigh it out and as always, find opportunities.
I should think one of them is the upside of interest rates. Let's flip the narrative and talk about some of the positive things that interest rate increases could bring.
Sure. So like anything, there are some meaningful opportunities once you see an interest rate increasing environment. I think one of the most important ones that we focus in on, or we're taking a step back and really reassessing this, is the importance of looking at the cash that people are holding on to, right? The money in a bank account, in their small or mid-sized savings bank, and even some of the large institutional banks. The average rate of money market or interest rate that people are getting is below 1% still in this type of environment with the large institutions and also the smaller ones. So when for us, like when we look at our business, right, we deal with Fidelity, as many know, and the custodian, they're yielding around 5% for a money market, right? So people that are holding on to cash with us, they're getting paid to hold on to that cash. So what we're asking our clients is saying, hey, look, if you have other assets, really be smart around repositioning that to make sure you're getting a competitive rate. Because as we all know, inflation is still elevated. And if you're not getting elevated or increased interest rates, then you're ultimately losing money to inflationary pressure. 2 years ago, when rates were zero, it was not as relevant. But now it makes a lot more sense as rates have increased. We look at your cash as it is an asset class now, and it has been, but now it's becoming a lot more relevant to get return of capital on your cash.
Any other things around short-term monies?
So other strategies that we are implementing for clients around short-term and as to what's happening in the environment, we're seeing what's called an inverted yield curve, which means that longer-term maturities right now are yielding less interest than the shorter ones, right? It's usually representative of a recessionary type of environment, or at least one that's going to become recessionary. That doesn't necessarily mean that it's going to be the case, but usually when you have an inverted yield curve, it tends to happen that way. What we're doing is we're taking some of the short-term money and relocking it back into CDs and treasury bills under 1 year, which are yielding a nice dividend higher than 5% currently, as to where the money market currently is. The one differential between CDs and treasuries, just to explain a little bit further, is that what we do is when we manage the portfolio, what we see is we look as to where the opportunity is better, if you will, or as to what's yielding more, whether it's a CD or a treasury. But the one just small nuance or difference between a CD and a treasury is that the treasury bills you don't pay state tax on the income that's generated, whereas CD you're paying ordinary income on both. So we look at both sides of it just to make sure there's a comparable tax equivalent. But currently you have to or should look at both to make sure that it's relevant. And the other part is people that are in retirement now more than ever, yields are starting to matter. Back then they didn't. So you should start looking at corporate bonds, start looking at muni bonds, which are triple tax-free in many different instances. They're looking a lot more attractive. So in other words, their cash flow now could be subsidized by income from bonds. Years ago, or a couple of years ago, the bond picture was more about total return, or about looking both at yield and the upside of bonds as rates were coming back down. But now that sort of narrative, if you will, has flipped in a way, because now it's more about the yield as opposed to the appreciation of the bond.
Okay, since we're talking about retirement, it's been challenging to generate yield, as you say, or income from investments. Are there any other benefits, though, for retirees?
Yeah. The other part is around the increase of Social Security. Regular benefits and entitlement payments, such as Social Security, are indexed to inflation. And these have risen as inflation has risen as well. The other thing is that we are also in a stronger dollar environment. And in this case, with the higher interest rates, this ultimately may lower the cost of imported goods from other countries, which leads into more positive or lower inflation, if you will. And lastly, for those traveling, which I think this is what's happened now, more so people traveling internationally, the fact that we have a stronger dollar, it is cheaper for Americans to travel overseas.
That certainly is a benefit. Thank you, as always, Roman. Very insightful information. Any last thoughts before we send you on your way?
Yeah, I think like everything, these are cycles, and Nothing is permanent, and having a plan and being now more than ever proactive is extremely important, and assessing your goals and objectives, and much more meaningful when you have these larger shifts in interest rates and the overall economy, and getting the right advice to make sure the things that you're doing ultimately fit into your overall financial picture.
Thank you very much, Roman. I know I, for one, am a little more at ease in understanding this interest rate moment we are in. So I'd like to thank you once again. His name, Roman Ciosek. He's the managing director and partner at Hightower Westchester. Thank you very much, sir, and do have a great day, or the rest of it.
You too, Bob. Always a pleasure. Thank you.
HighTower Westchester is a group of investment professionals registered with HighTower Securities, LLC, member FINRA and SIPC, and with HighTower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through HighTower Securities, LLC. Advisory services are offered through HighTower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analyses, prices, or other information contained in this research is provided as a general market commentary. It does not constitute investment advice. HighTower Westchester and HighTower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This podcast was created for informational purposes only. The opinions expressed are solely those of HighTower Westchester and do not represent those of HighTower Advisors, LLC, or any of its affiliates. HighTower Advisors do not provide tax or legal advice. This material was not intended or written to be used or presented to any entity as tax advice or tax information. Tax laws vary based on the client's individual circumstances and can change at any time without notice. Clients are urged to consult their tax or legal advisor before establishing a retirement plan.